Good afternoon, everyone, and welcome to the Equifax Market Pulse Quarterly Credit Trends webinar for Q4 2021. My name is Becky Oakes. I'm the AVP of Analytics here at Equifax Canada, and I'm delighted to be joined by two of my colleagues today for the session, Kathy Katsaleras, who is our AVP of Consulting, and Swanama Pandey, who leads our Insights Analytics team. Before we get started on the session, I'm just going to hand over to Sandra for some housekeeping about the On24 platform. Sandra.
Thanks very much, Becky, and good afternoon, everyone. Each area within the webinar platform is responsive, so you can maximize or minimize each widget or box based on your viewing needs. Our presenters are on camera in the media player on the left side of your screen, with slides showing in the middle. We'll have a polling question for you to participate in today, so watch out for that. There's an Ask a Question widget just underneath the media player, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there are too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation is available in the related content widget for downloading on the left, and French materials will be available in the next few days. Our session today is also being recorded, and you will receive the on-demand link via email tomorrow. Bios of our lovely speakers appear on your right, and some new features that we have today that you'll notice there's a smiley face widget at the bottom of your screen. Feel free to click on how you're feeling about today's presentation during the session, and you'll also see a Register Now widget, which allows you to register for our upcoming Commercial Trends webinar on March the 10th, and check that out. We ask that you provide your feedback by taking a short survey, which will automatically pop up at the end of the webinar, and you can also access it by clicking on the feedback icon at the bottom of your screen, anytime that you like. To the right of that feedback icon is a Contact Us button. Please send us an email if you'd like any further information, and a team member will be happy to help. Now let's get started. Becky, ladies, back to you.
Thank you, Sandra. I didn't know about the smiley emoji widget, so that's new to me, so thank you for letting us know about that one. So as always, I'm going to start off with a bit about what's going on the economic side, because this really can have quite a large impact in terms of credit behaviors and credit usages. So to start with, I guess one of the key things and one of the big focuses that we've kind of really seen over the last 12 months is really around what's happening on the inflation side. Now, during 2021, we had a lot of conversation around whether this would be transitory as a result of COVID and some of those supply chain issues. And we kind of hoped, I guess, that things were going to stabilize fairly quickly. Of course, as we are now seeing, this hasn't happened. And what we're starting to see more and more is this sustained period of inflation. And that definitely has the potential to have an impact on the credit industry. Now, this inflation isn't just linked to gasoline, which on the chart on the slide, you can see in grey. We know we've seen some big increases in terms of prices for gasoline. But it's also linked to some of the core elements like food. And that's seen quite a big movement. So if we look on the left-hand side again, the food is that top line, that dark blue line. And we've seen almost a 7% rise since the start of the pandemic in terms of the prices of food. We also see some big movements in things like transportation. That's up, again, 9.4% compared to pre-pandemic. And the reason why this is so important is that as we look at day-to-day costs going up, this can really start to impact consumers and in terms of their increased reliance on potentially on things like credit products. Particularly in some of those consumer groups, maybe who are lower income, perhaps a little bit closer to the breadline, just to purchase those essentials that can ultimately lead to some delinquency coming through, and definitely some kind of increases in terms of things like credit card usage. Now, one of the big things, of course, is how do you address this challenge with inflation? And as we all know, one of the ways we can do this is by increasing interest rates, so encouraging those consumers to start saving rather than spending. We did see the first move of this last week in terms of the Bank of Canada starting to make a small incremental rise on the interest rate side. And what we will talk you through later in the session is what have we seen historically when that started to happen? So should we be concerned about this right now? Or is this something where we might see gradual changes in terms of credit card usage over the next few months? Now, linked to, of course, inflation and the economic side is really what's been happening with some of those government support mechanisms and kind of what's been happening with COVID and the lockdowns and some of the relaxation of some of those. So if you look on the left-hand chart, what you'll see on the grey bar is the extent of income coming from government benefits. Now, this has continued to fall in Q4, although we're still above those pre-pandemic levels. So there are consumers who are still reliant on some of the government support really to help them through this period. But that has come down a lot compared to those highs of 2020. The good news you'll see on that left-hand chart is that employment income has picked back up again. And this is really still exceeding those pre-pandemic levels. So that's the good news. On the right-hand chart, we're looking at some of the impact on households in terms of what this has really done to some of the government, or some of the impact of the government support. So disposable income rose significantly during COVID, which is the orange line on the chart. And we saw large rises in savings rates. And really, we saw consumers really kind of getting that government support and having a real benefit in terms of what was going on there. Now, the key thing on that right-hand chart is really the savings levels. So if you look at those, we'll see they're starting to return closer to pre-pandemic levels. And this is really important because if we do start to hit this continuing inflation, if we start to see interest rates impacting some consumers during 2020, and if some financial stress is possible for certain groups, then of course not having as much savings may mean that there's kind of less buffer for them to really manage through that period. So that's kind of why that's kind of important. So that's kind of a brief overview of the economic side. We are going to talk a little bit later on in terms of some of the other things that are going on in the marketplace right now, particularly when we start looking, through some of the political challenges in Europe right now, because that also has a potential to impact some of these things. But we'll touch on that a bit later on. So let's start to look at what's happening on the credit trend side. Now, as always, we have our key indicators of the credit industry health. So let's start, I guess, with the average non-mortgage consumer debt, which is sitting at a little over 20.6K at the end of 2021. Now, movement-wise, this is a very slight drop compared to Q3, and it's down around 0.7% year on year. Now, we do know that Q4 was a big spend month on some products, in particular things like credit cards, and we've been talking about that a bit later on in terms of where we're seeing that. So although that level is down a little bit on Q3, we kind of expect that in January that's going to pick back up again. But just to remind you, it's still really below pre-pandemic levels. So you can see on the slide, we've added the Q4 2019 position, where average non-consumer debt was around 21.7K. So we have seen that big movement. And of course, the key drivers that we've talked to you over the last year on this has really been that reduced credit card balance. And more recently, we've seen some slowing in the auto and installment loan space as well. So that's kind of why we're still down in terms of debt levels compared to pre-pandemic. When we start to look at some of our severe financial difficulty measures, so for example, the 90-plus day delinquency or insolvency levels, we do get a little bit of volatility when we kind of compare to Q3 and 2020. And that's really because some of those have seen some huge movements since the start of the pandemic. So when we start looking at things like percentage change, you sometimes going from a really low position, and that can kind of impact some of those measures. But on the delinquency side, we are still seeing some continued drops. So we're currently at 0.86% for non-mortgage debt. And again, this is still much lower compared to pre-pandemic, where we were around 1.3%. The less good news is that we are seeing some increases in insolvency. So you'll see that in the second box. And we're seeing around 9% rise compared to Q3 and around 1% up from 2020. But again, still below pre-pandemic levels. So there is some good news there, but we're starting to see a little bit of stress coming through in some certain pockets on the consumer side. So of course, finally, let's look at the mortgage market. Probably no surprise here because we know, again, housing prices, the housing market, still really kind of buoyant. We've seen the average mortgage debt rise again, both quarter on quarter and year on year. So we're currently standing at around 242K. Now, Swanham is going to talk you through a bit more detail later on as to what's happening there. So the good news is that generally non-mortgage debt remains low. We've still got delinquency levels that are well below pre-pandemic levels. The less good news is that we're starting to see some of those insolvencies creep back in again in certain areas.
Hey, Becky, it's Sandra again here. If I could just interrupt, we're getting some reports that your audio is a little scratchy. Just wondering if maybe the microphone on your headset could go a little closer.
Potentially.
I think that would solve the problem.
Let me see. Is that any better, Sandra?
No, it's still a little bit scratchy, so maybe unplugging might work. Thanks, everyone, for your patience and bringing that to our attention. Can't hear you. No, can't hear you yet. The wonders of live audio. Well, maybe Swarmina, could we pass it off to you, and then we could help Becky with her audio?
Sure. We can wait for Becky to jump back in, and then she can start going with the slide. But meanwhile, I can start summing up what we are seeing in the credit market right now. So the first big change that we have seen is the credit card spending. It has been highest in the last, when we compare it to the last few years. And usually in the last quarter of every year, you do see higher credit card spending because it's the end of the year. But this time it's been way higher than all the other years that we have seen. So as consumer payment behavior is also slowly getting back to the pre-pandemic levels, spend is increasing, and the number of payments that people are making is reducing a little. It's still way higher than the pre-pandemic levels, but it's still going down a little. And as we see that the disposable income from government depletes, consumers will make less payments for every dollar they spend compared to the same time period last year. Another big change we saw this quarter was a drop in new mortgages. So it's a 8.1% drop when we compare it to the highs of Q4 2020. So in Q4 2020, we saw a huge hike in new mortgages. A lot of it was fueled by new sales, with even refinancing activities because of lower interest rates. So now when we compare this quarter volume to the highest Q4 2020, we see a good drop, but it's still higher than the pre-pandemic levels. So we can anticipate maybe slower credit market because of the high house prices that we are seeing, which is decreasing the affordability for a lot of segments, especially first-time home buyers. And another change we have seen is that lenders have started to move interest rate up in anticipation of the rise from Bank of Canada interest rates. So this may be limiting the purchasing power of many consumers. So in terms of delinquencies and insolvencies, we are still seeing record low levels of delinquencies as well as insolvencies, but we are starting to see small rises in delinquency, but it's usually quarter over quarter rise. It's nothing as compared to the pre-pandemic levels that we had seen. So delinquencies might likely go up in the next couple of quarters as government support is pulled back, and we have seen that COVID restrictions have still hurting some of the businesses. So we might see rise in delinquencies and insolvencies slowly and steadily in the next couple of months. So next we look at the overall consumer debt. So total consumer debt is at 2.24 trillion, with both mortgage and non-mortgage debt showing an year-over-year growth in mortgages. So if you look at the mortgage debt, it's up by 10.67% from Q4 2020, and even the non-mortgage debt, which has been relatively slower in growth in the last couple of quarters, is also increasing. And with higher consumer credit card spending, we are seeing that credit card balances are also increasing. For the first time, we are seeing that credit card overall balance have increased a little when compared to the same time period in 2020. And slight slowdown we have seen in installment loans, but revolving balances are also increasing, as well as a small slowdown in auto market. And a lot of those auto and comparable bank loan slowdown is due to the supply chain issues that we have seen in auto industry. But credit card is the one product that has shown an increase this quarter. It's still lower than pre-pandemic, but it's the first increase in this quarter.
Hey, Swarmina, can you now hear me again?
Yeah, I can hear you, Becky.
Okay, so I apologies for that, everybody. I'm so sorry. I'm not sure what happened there. So I'm not on video. Hopefully you do have me on the phone. I did see on the questions that it sounded like there was some duplicated audio. Has that now been rectified? If it hasn't, please do send us another question and we will take a look at that. So just to follow on what Swanima was saying there, so when we start to look at the delinquency level, so the good news is so far that severe delinquency rate is still relatively stable. So we're still at a low point in terms of when we look at the overall 90 plus, so 90 days without payment on non-mortgage debt. The less good news on the left-hand chart there, you can see that red line, which is early delinquency. So this is kind of where a consumer has missed 30 days or 60 days payment. And you'll see in Q4, we started to see that tick back up again. So you see that increase on the red line. Now, we saw this back in Q4 2020. And that was really where some of those government programs started to end. We also saw deferral programs ending, but it was quite a temporary increase. So we're seeing that again in Q4. And sometimes there is a little bit of seasonality in terms of an increase there, but it definitely is quite a jump. So this is one thing where we are closely watching. When we look on the right-hand side in terms of where that is actually coming through, you'll see that there's a bit of an increase on auto and also on credit card. Now, key thing to call out here on the auto side is that when we look back on Q3, that was actually at a real low in terms of delinquency level. So although it has increased and it looks like a big increase when it says 15%, it's coming from quite a low position, and that's probably why we're seeing that level. Credit card is really where we're starting to see a little bit though. And again, credit card tends to be one of the first products when consumers get into financial difficulty that they start to miss payments on. So this is one of the reasons why we are closely watching that kind of early delinquency to see, will it be temporary or will it continue into Q1. So again, just touching on the insolvency rate, which I mentioned earlier for those of you that could actually hear me. Left-hand chart shows us broken down by some of the key regions across Canada. The red dotted line is the all of Canada position. So you will see we still remain significantly lower than pre-pandemic. On the right-hand table, though, a couple of things to call out. When we look at kind of some of those western regions, so areas like Alberta, we are starting to see a kind of a movement in terms of year-on-year and quarter-on-quarter insolvencies coming through. Now, again, some of that's coming from quite a low position, which is the grey line on the left-hand chart, but we are seeing some delinquency as well. And we know some of those regions like Alberta tend to be quite volatile because it's linked to some of the economic pieces. So let's kind of move on briefly then just to credit scores. We touched a little bit on this last time as well. So we know that the average credit score has started to increase during the pandemic, mainly because of some of those shifts in terms of consumer behavior. What we have seen now is that it has stabilized. So it kind of has leveled off a little bit towards the back end of 2021. Now, of course, it's always important to watch what's happening with the credit score side of things because often we have lender strategies are linked to those. So if you are seeing a shift, sometimes you might want to adjust those strategy sides. So that's kind of all I wanted to say in terms of a summary. So I am going to hand back over to Swanima because it sounds as though I may still be having difficulties with my sound even though I'm on the phone. So Swanima, do you want to maybe talk us through what's happening on the credit card side?
Yeah, sure. Thank you, Becky. In this section, we'll dive deeper into credit activity and delinquencies for each product. So we'll start with credit cards. So new credit card volume is showing an upward trend and is finally getting closer to the pre-pandemic levels. The chart here clearly shows how new card growth was hampered by the pandemic, and it has taken a really long time to recover. While new card volume is up across all consumer segments, when we compare to Q4 2020, it's the younger consumers under the age of 35 that have shown the maximum jump in new card volume, even exceeding the pre-pandemic levels for consumers under 25. So just like new volume, average credit limit on new card has also increased and is up 3% when compared to the pre-pandemic period of Q4 2019. This increase is also being driven by younger consumer under the age of 35. Their average credit limit on new card is up this quarter by 11 to 12% higher than pre-pandemic levels. And since a lot of new growth is coming from younger population, we are also seeing a shift in credit score. The volume as well as proportion of 750 plus credit score consumers is declining when it comes to new card growth. Only 29% of new cards are coming from 750 plus risk score consumers as of Q4 2021, which is a 7% drop from Q4 2019 when it was 32%. So overall, it's the Gen Z and new to credit consumers who are driving the new card growth up and helping it reach pre-pandemic levels. And they're getting higher credit limits despite slightly lower credit scores. Now, in this quarter, we not only saw a high growth in new card volume, but also higher consumer spending. So spend levels in this quarter has been higher than ever. As you can see in these charts, average credit card spend per consumer is up 15% from Q4 2020. High spend has also resulted in slightly lower payments this quarter. So the chart on the right shows the spend to payment ratio of credit card consumers. Usually this ratio is high for last quarter as consumer spending increases at the year end. But this quarter, it was higher than previous quarter due to much higher spending that we have seen this quarter. So for every dollar consumers spend, they paid only $0.96, which is 3% lower than what we saw in the same time period in 2020. Now, multiple factors have affected high credit card spending this quarter. Holiday season, pent-up demand, easing travel restrictions, businesses reopening, ending of pandemic-related rules in a lot of provinces. So this may be a temporary increase in spending fueled by all these factors. Now, higher spend to payment ratio means consumer made lower payments, and lower payments have in turn led to small rise in delinquency and revolving behavior. Although, as you can see from the chart, the delinquencies are still way below the pre-pandemic level, but the 90-plus delinquency rate for credit card shows a 2.7% increase from the last quarter. And for credit cards, we are seeing the first quarter-over-quarter increase in this pandemic, and it's more visible across under 35 and senior 65-plus consumer segments. So throughout this webinar, we'll be looking at quarter-over-quarter rise in delinquencies to identify the first signs of financial stress. So these are small increments from last quarter, but as government support gets pulled back for consumers, we'll start to see a steady rise in delinquencies. And credit card delinquencies are usually a good indicator of early identification of financial stressed consumers. The next product we look into is auto. As we have discussed in the previous webinars, semiconductor shortage and supply chain issues have been a big problem for the auto industry, and it has slowed down the new auto growth even again for this quarter. We have seen a drop in volume this quarter when compared to Q4 2020. We had seen a drop last quarter as well. And the biggest drop we're seeing is in auto leasing activity, which was growing pre-pandemic and has shown a much bigger drop than auto loans. Now, lack of availability of new cars and a lot of uncertainty in auto industry might be driving consumers toward financing options instead of leasing. We also looked at new auto growth in other countries like UK, Australia, and the US, and all of them show a similar drop in new auto volume, with some countries anticipating a much bigger slowdown in the next coming months. In Canada, auto lease volume remained low across all segments. The first segments we are seeing a slight rise in new auto volume is new auto loans and comparable bank loans, and especially in lower score segments, so deep prime segment. This is not very alarming as these are the segments where we saw the biggest drop in new auto loans in Q4 2020. Hence, the increase looks much higher when compared to the lows of Q4 2020. Now, another segment where we have seen a higher recovery rate is used car segments. Again, lack of availability, increasing wait times for new cars, and higher prices for new cars has increased the demand for used cars. Now, since the used car demand is up, we are also seeing a bigger increase in average used car prices. So used car prices have been increasing at a much higher rate than new cars since the start of 2021. Now, auto is the second product where we have seen a rise in delinquency levels. As you can see in this chart, both auto and comparable bank loans, the delinquencies are below pre-pandemic levels, but non-bank auto is showing a small quarter-over-quarter increase in 90-plus delinquencies. And just like credit cards, we looked at quarter-over-quarter increase in delinquency for all age groups to identify where the delinquencies are rising first. So delinquencies among seniors show the biggest increase in all auto segments when compared to the lows of last quarter, where auto delinquency saw a big drop. Despite this, it is crucial to monitor consumer segments that are more vulnerable and are showing first signs of financial stress. Now, moving on to mortgages, we have talked at length about the hot housing market and its accelerated growth that we saw since the second half of 2020. And after showing big year-over-year increase in volume, new mortgage growth has finally slowed down when compared to the rise that we saw in the beginning of 2021. So the volume dropped by 8.1% when compared to the highs of Q4 2020. But as you can see in the chart, the levels are still higher than pre-pandemic period. So first, let me clarify that our new mortgage volume includes first-time home buyers, repeat purchases, refinancing, as well as renewals. So overall, the second half of 2020 saw a huge rise in new mortgages, not only in terms of new sales, but also in terms of financing and renewals due to lower interest rates. And usually Q4 is a lower quarter in terms of new mortgages, but in 2020, due to the pandemic, a lot of mortgage activity was pushed towards the second half of the year. Hence, we saw a huge increase in Q4 2020, and the drop that we are seeing in this quarter is in comparison to the high volume we saw in Q4 2020. Now, this drop in new mortgage volume is seen across a lot of major cities like Toronto and Vancouver, which had high mortgage activity in Q4 2020. And growing house prices have reduced the affordability among many first-time home buyers, especially in some of the hot housing markets. And potential interest rate hikes could also be affecting refinancing activity. So the lower new mortgage volume might be the result of these factors. In the past few quarters, we have not only seen a rise in new mortgages, but also the exceptional rise in average home prices. And although average loan amount showed a small drop of 1.2% this quarter when compared to the last quarter, it is still 10% higher than Q4 2020. And the most affected with skyrocketing high prices are the first-time home buyers, whose volume dropped by 13.3% when compared to Q4 2020. So their share of first-time home buyers have also shown a drop among new mortgages. The right-hand side chart explains in detail why some of the first-time home buyers might be priced out of the market. So low interest rate has been a boon for many first-time home buyers as they could purchase houses even with rising home prices. Now the chart shows year-over-year change in both new mortgage loan amount as well as average monthly payment for first-time home buyers. So all through 2020, you can see that the average loan amount kept increasing when compared to 2019. But the monthly payments don't show the same increment because of low interest rate. But when we look at 2021, the monthly scheduled payments amount have also started to increase with the average loan amount increase. So this is also because a lot of lenders have preemptively increased interest rates in anticipation of Bank of Canada raising their interest rates. So high home prices with high interest rate could push many first-time home buyers out of the market. Now let's look at mortgage delinquencies. So unlike credit cards and auto, mortgages have not shown any increase in 90-plus delinquency levels. In fact, mortgages 90-plus delinquency rate dropped again this quarter when compared to Q3 2021. So deferral program, SERP payments have kept delinquencies from rising, especially mortgage delinquency. But when we looked at, so that's why we looked at 30-plus delinquency rate for mortgages. And we do see a small increase from last quarter. But in general, 30-day delinquencies are very volatile. So they don't always roll over to 60-day delinquencies, but it is a good idea to monitor the early rises to prevent future losses. And we're seeing a higher rise for Atlantic and Alberta provinces, In general, they usually have a higher mortgage delinquency rate when compared to all of Canada. But as of now, delinquencies are still below pre-pandemic level, and it will take a long time for them to reach pre-pandemic levels, especially for mortgages, because it's usually the last product that consumers default on. Another product that is very closely linked to mortgages is HELOCs, which has also shown a drop in new volume this quarter. So as interest rates rose back up in 2018, we saw that new HELOC growth started to slow down. But in 2020, a strong housing market coupled with a low interest rate revived HELOC growth. As you can see, new HELOC balance started increasing in the second half of 2020, but it is slowing down a little in 2021. But new HELOC growth did not impact the overall balances, HELOC balances. So high home prices led to higher value HELOCs, but the utilization on those HELOCs remained low. And also during the pandemic, the disposable income increased for many consumers, which helped them pay down their HELOC debt. So overall, if you look at the HELOC balance, it did not have a major impact due to the increasing HELOC volume that we saw in early 2021. Now, we can expect another slowdown of new HELOCs, similar to what we saw in 2018, as multiple interest rates hike are expected in 2022. So this will definitely affect new HELOC volume because it's a variable rate product. We will talk more about how rise in interest rate affects consumer payment behavior in our next section. But before we move on, Becky, do we have any questions?
So we do have one, Swanam. I don't know if you know the answer to this off the top of your head. So where we are seeing increases on the insolvency side, are we seeing that on bankruptcy or consumer proposals or equally on both?
No, so higher increases are for consumer proposals and not on bankruptcies. So they're both increasing, but it's the consumer proposal where you see the biggest increase.
Okay. And I think that was the only question so far. So, just to the audience, if there are any questions, please do keep them coming in. We absolutely would love to answer those questions as we go through this. So I think in terms of the next section, I think we do have a poll question potentially coming in next. So for those of you that can, please do take a look and answer the question, because we do love your feedback on our polling questions. So the question today is, what do you think will have the highest impact on the viability of your portfolio with the rise of interest rates? So we have the options there of the early rise in credit card delinquency, consumer insolvencies, first-time homebuyer affordability, or HELOC or variable products. So that's a polling question. So please do feel free to just kind of go on, pick which options you think apply to you, and we will give it 30 seconds and then see what the results look like. Okay, so we'll have a look and see what the results are showing us. So it looks like first-time homebuyer affordability, 38.4%. That's kind of the key one, and absolutely that's going to be, as Swanima was talking to a few minutes ago. This is kind of one of those key areas which we are closely watching, because as we have interest rates going back up again, that's going to make it a bit more challenging. In terms of the ability for those first-time home buyers to get on the housing market. And then, of course, we have consumer insolvency, delinquency, and HELOCs. Okay, so thank you for the poll. We do take that away, and we use that to kind of help feed into some of the focus areas for the next session. So we definitely will look at those. Okay, so let's move into our next section, which is we want to talk a bit about all this information we've been getting around the credit behaviors we're seeing. What should we be thinking about going forward? And Kathy is going to help give a bit of a consulting view on this in terms of what it might mean for some lenders and what you should be thinking about. So kind of back to begin, again, I know my sound wasn't great. We talked a bit about interest rate rises and some of the impacts that can have on the credit behavior side. So what we have done is we've taken a step back and looked at what happened when we last saw some large increases on interest rates, which was kind of back in 2017, and some of the impacts that kind of flowed through into 2018 and 2019. So some key things that we start to see as early indicators of financial stress. first one is on credit card payment behavior. So you'll see in that left-hand chart, this is where we're looking at what's happened to kind of some of the pay rates on credit cards and some of the consumers paying their balance in full. And what we saw once interest rates started to rise was a clear drop in terms of the percentages that were paying in full. So we saw more revolvers, less transactors. And that tends to be a bit of an early indicator that potentially some of those consumers might be seeing some financial stress. Other thing we often see is insolvency rates. So again, back when we look at what happened historically, we saw about 12 to kind of 18 months after the interest rates really started to kind of take hold, and we saw multiple increases. We saw an increase in insolvencies overall, but in particular on what we call as surprise insolvencies. So this is where there isn't really any pre-warning from a delinquency standpoint. So consumers up until this point are looking fairly good in terms of their credit usage and credit behavior. Then we suddenly see them becoming insolvent. So we did see a rise, and we saw in particular a rise on some certain age groups, and certainly where there was some usage of variable rate products like HELOCs. So that's what came through last time. And then finally, when we look at the non-mortgage debt side and non-mortgage delinquency side, we do start to see a bit of movement, in particular on non-mortgage. So although people often think interest rates must impact the mortgage, it doesn't necessarily, because obviously that's a really important product for consumers in terms of keeping their payments going on their homes. So typically that's the last one that's ever going to go delinquent. So actually it's non-mortgage delinquency where we start to see the biggest rises when we have interest rate increases. Just to give a bit more detail on this, what we've done is try to break apart what happened back in 2016 through to 2018 when we had some of these rises. And you'll see on the screen here, we have a 50 bip, 100 bip, and 125 bip movement. And some of kind of the key indicators that we see in terms of shifts. So you see in that line where we have on the credit card side, the percentage of transactors, so people paying in full. When we got to kind of the largest interest rises, so towards the 100 bips, we started to see quite a big drop in terms of the percentage of transactors, in particular for those that have those high balance variable rate products like revolving HELOCs. So that kind of fell around 4%. On the insolvency rate side, by the time you're getting up to 100 bips, that's when we're starting to see a pretty big jump. Again, we saw it on certain age groups. So in this case, historically, we saw it on the older age groups, around 13% increase once we had the 100 bip move. And again, when it moved a bit more, that's actually going up to around 36%. And actually overall, it was increasing around 23%. So insolvencies certainly start to hit as you get up to some of those larger movements on the interest rate side. And then the non-mortgage delinquency side, again, you'll see towards that right-hand column, the 125 bips. Again, that's where we start to see, more impact on consumers with variable rate products like HELOCs on delinquency, up around 19%. But overall, we're seeing a 10% shift. So these are just some of the things that we tend to see when interest rates happen. So I guess, Kathy, I want to bring you into the conversation around, so what should our lenders be thinking about if this is what might be coming next?
Yeah, thank you, Becky. So before we get there, actually, I just want to make sure I can help summarize, because we've heard quite a bit today so far. So specifically, again, understanding that, again, with inflation on the go, and in order to curb it, again, related to the price of day-to-day goods, such as food and gas, we've been seeing them increase at an alarming rate. Obviously, we saw last week that the Bank of Canada has finally taken that first step in using monetary policy to really increase those interest rates since the start of the pandemic 2 years ago. And we know that this will continue in the coming months to really cool down that activity, such as really cooling the hot housing market that we heard Swarnava talk to us about, as well as force consumers really to slow down on that spending and shift their focus to perhaps saving, given the potential for a higher rate of return. We also heard that for consumers that have variable interest rate products such as cards and HELOCs, they're likely going to be more at risk in terms of experiencing that financial stress. And we heard, and we've seen that government support is essentially almost completely pulled back. And the household saving rates have dropped to pre-pandemic levels. So again, where there was a buffer for certain consumers in terms of having that disposable income, there's risk that it's been depleted in many cases. As Becky just mentioned, historically, last time we saw interest rate hikes in 2018, we saw with that insolvency rates and delinquency rates for non-mortgage debt really increased significantly. And more specifically, it was insolvency rates for that older 65 plus demographic that they contributed mostly to this increase, as well as, again, the consumers that had HELOCs. So putting this all into perspective, changes to the interest rate hikes and the learnings from the past, as a lender, what exactly does this mean to you? So it's going to be very important if you are a lender to really, really closely monitor and identify these pockets of consumers in your portfolio who will be impacted significantly. So key things to look for are early signs of really relying on credit to get by, perhaps a demand for increased credit limits or net new credit products appearing on their credit report. Other signs might be sort of, again, higher utilization rates, payment rates starting to decrease, as well as the shift of going perhaps from being a transactor to a revolver. All of this types of behaviors can obviously put the consumer at risk of rising delinquency and insolvency rates. The other thing, again, that we mentioned, just to bring it back, you might want to keep an eye out on that older demographic who is at more risk of filing for a proposal, as seen historically when interest rates increased. Last thing I just want to touch on, again, with regards to the hot housing market, affordability is going to obviously remain a key issue in that you may start to see that those first-time home buyers might be being finally pushed out of the market because of the higher interest rates, as well as that higher monthly mortgage amount that would be required, and sadly, what they may not be able to afford. To you to talk to us about buy now, pay later.
Yes, sure. Thank you, Kathy. So buy now, pay later. So just a bit of background in terms of, what we're seeing in terms of the buy now, pay later market in Canada right now. So when we look at kind of some of the users, kind of people who are, making some kind of inquiries linked to buy now, pay later, probably unsurprisingly, we see that there is a bigger population that is the younger consumers. So those under 35 years of age, they tend to be kind of some of the primary users of buy now, pay later. And when we look at that in terms of compared to credit cards, particularly when we look at some of the provincial differences, we actually see quite a lot of use in Ontario in particular compared to some of the other regions. So quite an interesting mix. Again, that tends to be younger, tends to be a little bit more in buy now, pay later in the Ontario regions. When we start to look at how these consumers are using credit elsewhere right now, apart from buy now, pay later, it's quite interesting because they do tend to have a higher utilization on their credit cards. So that balance to limit ratio tends to be typically higher. So although we sometimes might assume that buy now, pay later are purely just consumers that maybe are younger and don't have access to traditional credit methods because they don't have a credit history, we actually do see that a lot of them do have the access to some credit, but they are using it quite heavily already. So again, that left-hand chart, you'll see that big red bar, 71 to 100%. That's their credit card utilization. We do see quite a big chunk in there that is quite kind of a high population in there. So generally speaking, when we look at the consumer profiles of these, we tend to see they are a little bit high risk, so they tend to have lower credit scores. Now, some of that could be because perhaps they're new to credit, being slightly younger, and therefore they haven't had enough time yet to really develop a strong kind of credit score. And we do sometimes maybe see that they have a slightly less credit history in terms of when we look at when a credit file was open. So almost a quarter of them, they have a credit file less than 3 years. So they tend to be a little bit younger. They maybe tend to have a bit more credit usage going on at the same time. So when we look at that, Kathy, obviously this is a big industry shift in terms of we're seeing in some of the global regions as well. There's some movement going on. Again, kind of what should our lenders be thinking about when it comes to buy now, pay later?
Okay, so before I jump right into that, a couple of things. I just want to call out that I think we've all seen by now how buy now, pay later is really growing in terms of being that alternative way to pay for items, especially through the popular digital retailer channels. all of us, of course, doing that online shopping versus, again, just the traditional method of just using the credit card. And Becky, as you just mentioned, really it's the younger generation who typically have have lower credit scores. They're really leading this trend in terms of leveraging buy now, pay later as a payment option. And you're right, this isn't just a trend that is isolated to Canada, but we're seeing this across the globe. Buy now, pay later is definitely here, and it's really, again, growing in popularity. In the UK, we see that consumers there have been leveraging buy now, pay later as a payment option, and that trend has been increasing significantly year over year. In the US, there's been over 50 million consumers who have used a buy now, pay later option in the last 12 months. And based on a recent survey, half the population noted that they were planning on using buy now, pay later as an option in the coming year. On the other side of the world, down under, in Australia, where buy now, pay later has been there a little longer, we've actually seen the demand for new credit cards been falling since 2018, and strong growth on the buy now, pay later demand side. So what does this rising trend really mean? And specifically for card groups, seeing this increase in activity and competition in many cases, it's going to be important for you to really assess how you're being competitive and what makes your product more attractive for those seeking new credit, especially, again, when there's other options like buy now, pay later in the market. For many providers, what this has actually meant has been pivoting to offer your own version of a buy now, pay later to stay competitive. So creating a new strategy, implementing buy now, pay later as a new product offering might be an option, again, for card groups. On the risk side, it's going to be very important to understand that for consumers leveraging buy now, pay later, you may not have a good understanding of that consumer's payment capacity because currently buy now, pay later trades are not being reported to bureaus, which means there may be some blind spots for that consumer's true financial position and overall affordability levels. Becky,
fantastic.
Let's move into our last section to talk about sort of some of the turmoil happening, I guess, overseas.
Yeah, absolutely. And, when we look at some of the things that hopefully you kind of heard at the beginning on the economic side, we are looking at some of what's happened through history when we look at things like interest rates. But right now, of course, we are in a period which we've never seen before. So not only do we have the massive impact of this global pandemic, all the turmoil that's caused for our businesses, for employment, for supply chains, we're going to add to that right now. We have the issue that's going on in Europe right now. And it's a bit of the elephant in the room, unfortunately, which is this could also lead to some additional impacts here in Canada when we start to look at the credit market. So again, just back to the economic side. So we talked about already what had happened with inflation linked to gasoline prices. Now, for any of you who have been watching the news, looking at what's going on in the markets right now, it's kind of crazy when you start to look at what's happening with the prices, and understandably because obviously there's a lot of fuel production that kind of happens out in some of those regions. So this left-hand chart, you see that blue line, that huge spike where oil prices rose massively in the last week. So that's one element that's going to put additional pressure on inflation and also the ability for interest rates to really start to control that. The other piece, though, is, again, this is not just linked to crude oil. So when you look at some of these regions that are very unstable right now, there is a lot of global supplies that come from them. So, again, on this chart, you'll see that green line, that's wheat. Now, you may not think instantly of wheat when you kind of think of Ukraine and Russia, but actually they are some of the, some huge production that comes from there. If you look at things like sunflower oil, again, another huge provider of sunflower oil globally. So there are certain products that actually suddenly become potentially much more expensive, huge inflation that we could see if this doesn't get resolved quickly. And even if it does get resolved, there could be some longer term impacts. And again, back to what I said at the beginning, for consumers, day-to-day living costs, they're already really high. We've already had this continued inflation. So this really could start to impact a little bit further. So I guess, Kathy, with that going on, what are your thoughts on what lenders should be thinking about with this additional complexity added to things?
Yeah, a couple of things. So first off, as you just showed, we've seen like the oil prices really start to accelerate, and specifically, given that we've got the international conflict happening between Ukraine and Russia, I think it's accelerated even more. Just last week alone, here in Toronto, we've seen our gas prices hit that all-time high of it's at 184.9. Cents per liter compared to where we finished off in 21, which was 143.9. On the West Coast, actually in the greater Vancouver area, just on the weekend, it was at 215 cents per liter. So again, everybody's really feeling the pinch with regards to the price of oil. And with the current inflation rates for, again, day-to-day goods and services, it's going to impact consumers, businesses, and the economy overall. So a couple of comments, with the tensions really growing between Ukraine and Russia and all the sanctions against Russia, we expect to see sort of further disruption to the global supply chains, which were already impacted, as Farnima talked about, during the global pandemic. What's happening overseas, is expected to really have ramifications, not just for European trade, but across the globe. Case in point, we're seeing that impact on the oil prices rising to all-time high levels here. Another concern is really that, Bank of Canada just increased interest rates to curb inflation, but is that going to be enough given the disruption overseas? So coming back to, as a lender, what does this mean to your portfolio? And this is where, again, there needs to be some extra diligence in really monitoring your portfolio, given that, again, the prices are rising across the board for all day-to-day goods and services. There's going to be a strain on that consumers' payment capacity and their ability to pay back debt. Again, we mentioned previously, and it's applicable here as well, that consumers' household disposable income, it's been decreased given the inflation rates. Which means there's less savings or that buffer to dip into for a rainy day. We may also see, again, consumers going from being transactors to revolvers, that increase in demand that we talked about. Again, it's relevant here, and it'll also be accelerated because of the conflict happening. And all of this, again, all these early signs, which will point to, again, perhaps consumers really sort of seeing that increase in the delinquency rates and insolvency rates starting to creep up. So overall, the expectation is that there's going to be more stress with regards to consumers' financial position, which will mean, as a lender, you must take those proactive steps to really monitor and address. On that note, I'm going to just end there. I just want to comment from a humanitarian perspective. I want to really extend my thoughts and prayers to the families and the innocent civilians that are being impacted by this conflict. And I really hope that there's an amicable resolution for peace to come soon. So on that note, Becky, I'm going to turn it back over to you to see if we've got any questions from the audience.
Thank you, Kathy. And absolutely, I wholeheartedly share your thoughts. It's very easy for us to look at this purely from a economic and business standpoint right now, but obviously the impacts are much more widespread. So hopefully that's been useful for everybody today. I mean, I'm just looking at the questions. I don't think we have any. So, are there any new questions that have come through?
No, not yet.
No. Okay. So I think that's kind of all we really have for you today. So I think there's been some key themes that we've kind of talked about in terms of what's happening with mortgages, some of the credit card spend, some of those early warning signs we might want to look at as interest rates start to increase. But again, this is a complex situation we're in right now, and there's been so much in terms of differences to historic. History doesn't always predict the future, unfortunately, when there's kind of some big fundamentals that are different. So what I would like to say is, I know Sandra mentioned it earlier, we do have our Q4 2021 Small Business Credit Trends webinar, which is coming up on the March the 10th. from 1 o'clock Eastern time, and we have Jeff Brown, who's our small and medium business leader, and we have Pierre Cleroux, who is from BDC. So they're going to be talking to you about what's happening on the small business side. So there's going to be some great insights. I mean, we definitely know that the small businesses are key to the Canadian economy, and they have a huge impact on consumer as well. So highly recommend attending that session. If you haven't done so already, there is a survey for today's session. Please do take the time to fill it in. We'd love to get your feedback and figure out where we're missing the mark, or indeed if there are things that you want to see in future. Apart from some clear quality on sound, I do apologize again for my whatever's going on with my headset earlier on. And apart from that, thank you so much for joining the session today. It's always a real pleasure to speak to you, and we will hopefully see you next time.